There is a threshold that gets discussed in theoretical terms for years before it gets crossed in practice, and then, quietly, it gets crossed. The United States government is now paying more than $1 trillion per year to service the interest on its national debt, not to reduce the debt, not to build anything, not to fund any program that produces a future return, purely to pay the interest, the cost of carrying the accumulated borrowing of previous decades into the present. In the first 6 months of fiscal year 2026 alone, October 2025 through March 2026, the Treasury paid $529 billion in interest. That is more than $88 billion per month, more than $22 billion per week, more than $2.8 billion per day. To put that in concrete terms, for that 6-month period, the interest payments on the national debt were roughly equal to the combined spending on the Department of Defense and the Department of Education. Not one of them, both of them, combined. And the trajectory is not stabilizing. The Congressional Budget Office, the nonpartisan federal agency that produces the government's official fiscal projections, projects that annual interest costs will double from $1 trillion in 2026 to $2.1 trillion by 2036. That means by 2036, the United States will be paying $5.9 billion per day simply to service existing debt. This is not a political statement. It is a mathematical description of a system that has crossed a line. The United States no longer borrows primarily for growth. It borrows in significant part to sustain the existing structure, to pay the cost of yesterday's borrowing with tomorrow's obligations. And that transition from debt as a tool of investment to debt as a self-reinforcing gravitational force is the event that this video is about. This is Capital Briefing. If you are here for the first time, subscribe now before we continue. Turn on notifications. What we build on this channel is the translation of structural macro-financial shifts into the framework that lets you understand what is happening before the public narrative absorbs it. Subscribe now. Then let me explain exactly what has changed and why it matters for everyone watching. Let me start with the mechanism, because the numbers alone are not sufficient to understand what is actually happening. When a government borrows money, it issues debt, treasury securities. Buyers of that debt, domestic institutions, foreign governments, pension funds, central banks, receive interest payments over the life of the security in exchange for lending their capital to the government. In normal conditions, this is a functional and productive mechanism. The government raises capital at a competitive rate, deploys it into productive uses, infrastructure, research, social programs, and the economic growth generated by those investments creates tax revenues that service the debt. The debt grows in nominal terms, but it remains manageable as a proportion of the economy because the economy is growing at least as fast as the debt. That is the functional model. It worked imperfectly but workably for most of the post-World War II period. What breaks that model is the combination of 3 specific conditions occurring simultaneously. Condition 1. The debt becomes large enough that the interest payments themselves represent a significant share of government revenue. Not just a manageable line item, but a structural constraint on fiscal decision-making. We are there. The CBO projects that interest costs will represent 18.6% of all federal revenues in 2026. By 2036, that ratio climbs to 25.8%. 1 in every $4 the federal government collects will go directly to interest payments before a single dollar is allocated to defense, to healthcare, to education, to infrastructure, to any other category. Condition 2. The interest rates at which the debt must be refinanced are structurally higher than the rates at which it was originally issued. We are there. From 2010 to 2021, the 10-year Treasury yield averaged approximately 2.2%. Since 2023, it has averaged above 4%. The CBO projects the 10-year yield will average 4.1% in 2026 and gradually rise to 4.4% through the decade. This matters because trillions of dollars in debt issued at the old low rates must now be refinanced at the new higher rates. Every time a security matures and the Treasury issues new debt to replace it, the government locks in a higher interest cost for the next cycle. The old debt is repriced upward, mechanically, automatically, regardless of what the Federal Reserve decides or what the political environment looks like. Condition 3. The deficit is large enough that the debt is growing faster than the economy. We are there. The federal budget deficit in fiscal year 2026 is projected at $1.9 trillion. The CBO projects deficits will average 6.1% of GDP over the next decade. And that debt held by the public will rise from 100% of GDP today to 120% of GDP by 2036, surpassing the previous all-time record of 106% set immediately after World War II. The difference is that in 1946, the debt was a wartime emergency that was actively paid down in the following decades. The current trajectory, under existing law, continues rising. All three conditions are present simultaneously, and their interaction creates the mechanism I want to spend the next several minutes describing precisely, because it is not widely understood. Subscribe to Capital Briefing if this framing is giving you the structural context you have been looking for. Turn on notifications. The next video on this channel examines what institutional capital allocation actually looks like in response to sovereign debt stress, where the largest pools of managed money are quietly repositioning and what that repositioning tells us about where this trajectory leads. Subscribe now. Then let me describe the self-reinforcing loop. The mechanism is what fiscal economists call a debt service spiral, and it works like this. Higher debt requires more borrowing to service existing obligations, not just to fund new spending, but to pay the interest on what was already borrowed. More borrowing at higher rates increases the annual interest bill. A higher annual interest bill crowds out other spending or requires larger deficits, which require more borrowing, which increases the debt, which increases the interest bill. The CBO described this dynamic explicitly in its long-term budget outlook. Rising interest costs also contribute to a vicious cycle of higher debt and additional interest costs. The word the CBO uses is vicious cycle. That is not a phrase those analysts choose casually. The critical feature of this loop is that it is self-reinforcing, independent of fiscal policy decisions. Even if Congress were to freeze all discretionary spending, defense, education, infrastructure, every program subject to annual appropriation, the structural debt service dynamics would continue to grow the debt because the mandatory spending categories, Social Security, Medicare, and interest payments themselves, are not subject to annual appropriation. They are automatic. The CBO projects that by 2038, interest payments on the national debt will exceed all discretionary spending combined. Not just defense, not just education. All discretionary spending, everything that Congress actually votes on each year, will be smaller than what the government pays simply to carry its existing debt. That is the structural condition the current trajectory is moving toward. And the question is not whether the numbers are correct. They are the official projections of the nonpartisan Congressional Budget Office. The question is what happens in markets when those numbers become the operative reality that sophisticated institutional investors price. Let me now explain why the refinancing wall is the most immediate and most underappreciated risk in this picture. The United States government issues debt across a range of maturities, from 4-week Treasury bills to 30-year bonds. When those securities mature, the government must issue new securities to replace them. That is called refinancing or rollover. The problem is the timing and the volume. During the pandemic and its immediate aftermath, 2020, 2021, early 2022, the Treasury issued enormous volumes of short-term debt at near zero interest rates. That debt is now maturing or has recently matured and must be refinanced at current market rates that are approximately 200 to 400 basis points higher than when it was originally issued. The Treasury has been managing this by issuing large volumes of short-term bills, precisely the instrument that has been in record demand from money market funds, from institutional cash managers, from Berkshire Hathaway's $339 billion position we described in another video. This bill-heavy issuance strategy keeps the immediate cost manageable, but creates a structural problem. A large portion of the debt must be refinanced again and again and again in short intervals, each time at whatever rate the market demands at that moment. If the market decides at any of those rollover points that the risk profile of U.S. Treasury debt requires a higher yield to attract buyers, the cost of that rollover rises immediately. And because the volume is so large, even a modest increase in the yield required by the market translates into tens of billions of additional annual interest costs. The CBO explicitly identified this as a risk factor in its long-term outlook. The nation's fiscal position is more vulnerable to an increase in interest rates. The agency went further, noting that in a fiscal crisis, rising Treasury rates would reduce the market value of outstanding government securities, and that losses on those securities held by banks, insurance companies, mutual funds, and pension funds could be large enough to cause some financial institutions to fail, with consequences that could spread globally as liquidity declined and financial institutions reduced their lending. This is the official language of the Congressional Budget Office describing the potential downstream consequences of the current fiscal trajectory, not a political advocacy group, the nonpartisan Federal Budget Agency. Let me now place this in historical context, because the current situation is not without precedent, but the precedents are not encouraging. The 1970s, fiscal pressure plus inflation plus high interest rates. The United States entered the 1970s with fiscal pressures from the Vietnam War and the Great Society programs, large deficits by the standards of the era. When inflation accelerated through the decade, the Federal Reserve under Paul Volcker ultimately raised interest rates to 20% in 1981 to break the inflationary spiral. The consequence was a severe recession in 1981-1982. Businesses that had borrowed at floating rates faced dramatically higher costs. Government debt service costs rose sharply. The combination of recession and high interest rates made the fiscal picture worse before it got better. The important parallel, the transition from low-rate to high-rate debt refinancing, was painful, not because the structural decisions were different from what we see today, but because the volume of debt requiring refinancing was smaller. The current situation involves the same mechanism at a dramatically larger scale, with a federal debt that is roughly 5 times larger as a percentage of GDP than it was entering the Volcker era. Japan after 1990, the extended fiscal trap. Japan represents the most complete historical laboratory for what happens when sovereign debt reaches levels that constrain policy responses for decades. After the asset price collapse of 1990, Japan responded with fiscal stimulus, large deficit spending to support the economy. Debt to GDP rose from roughly 65% in 1990 to over 250% today. The Bank of Japan has held rates near zero for most of the last 3 decades to keep the debt service costs manageable, but at the cost of creating a system so dependent on low rates that any normalization of interest rates would itself create a fiscal crisis. Japan has not experienced a sovereign debt crisis in the conventional sense, but it has experienced 3 decades of structural fiscal constraint, government debt levels so high that they systematically crowd out private investment, suppress economic dynamism, and leave the government with almost no fiscal capacity to respond to new challenges. This is not the catastrophic scenario. It is the slow-motion scenario, and in many ways it is more instructive because it demonstrates how a developed economy with an independent central bank and functioning institutions can still end up in a condition of persistent fiscal trap with no obvious exit. The United States is not Japan. The dollar's status as the world's reserve currency gives the U.S. a structural advantage that Japan does not have, but that advantage is not unlimited, and the trajectory we are describing is precisely the mechanism through which reserve currency advantages can erode, not suddenly but gradually through the accumulation of compounding pressures. Argentina, Greece, and the speed of the alternative. The United States is not Argentina. It is not Greece. The structural differences are enormous. But Argentina and Greece serve as important boundary conditions in this analysis. They illustrate what happens when the slow-motion fiscal trap scenario suddenly converts to the rapid deterioration scenario. In Greece's case, the conversion happened when the bond market repriced Greek sovereign debt to reflect the actual risk it was carrying. Yields rose from approximately 4% to over 35% in a period of months. The Greek government was suddenly paying rates that made its fiscal trajectory not just difficult, but arithmetically impossible to sustain. The United States will not reach Greek-style yields. The global economy is too integrated with U.S. Treasury markets, and the consequences of a U.S. sovereign debt crisis would be too severe for too many parties for a Greek-style market repricing to occur. But the relevant lesson from Greece is not the endpoint. It is the mechanism. Markets can reprice sovereign debt faster than governments can adjust fiscal policy. The adjustment that takes years to implement in a political system can be demanded in days in a bond market. That asymmetry, slow political adjustment, fast market adjustment, is the fundamental risk that the current U.S. fiscal trajectory creates. Now let me explain what the data tells us about how institutional capital is reading this situation, because institutional behavior is always more informative than institutional statements. Foreign holdings of U.S. Treasury securities have been declining as a share of the total market. China has reduced its Treasury holdings to approximately $730 billion, the lowest level since 2008, down from a peak of over $1.3 trillion. The official explanation is portfolio diversification. The structural reality is that major foreign holders are reducing their exposure to long-duration U.S. debt at precisely the moment when the U.S. needs to issue more of it. Gold has exceeded $4,000 per ounce in 2025, reaching multiple all-time highs. Central bank gold purchases hit record levels, buying 313 tons in Q3 2025 alone, a 10% increase year over year. Central banks, the most conservative institutional capital managers on earth, are systematically diversifying away from US dollar-denominated assets into the one asset class that carries no counterparty risk and cannot be debased by government action. Money market funds hold $7.75 trillion in short-duration Treasury-backed instruments. The largest stock of institutional liquid capital in history is positioned in the shortest duration, most liquid, most sovereign-backed instruments available. The pattern is consistent across multiple data points. Institutional capital is positioning for a scenario in which long-duration U.S. debt carries more risk than its current pricing reflects, and in which the ability to remain liquid and mobile is worth more than the return premium of longer-duration commitments. This is not a conspiracy. It is the mechanical response of sophisticated capital allocation systems to the mathematical reality of the debt trajectory that the CBO has been projecting with increasing clarity and increasing alarm. The public is mostly not seeing this pattern. The mainstream financial narrative remains focused on equity markets, on AI productivity gains, on quarterly earnings. The structural fiscal deterioration is happening in a register that most people do not track until it produces consequences that are impossible to ignore. That gap between what the structural data shows and what the public narrative discusses is the information asymmetry that this channel is built to address. Let me close with the most important structural observation about what the $1 trillion interest payment threshold actually represents. It represents the crossing of a line from which fiscal trajectory changes are increasingly difficult to execute through normal democratic political processes. When interest payments were 10% of revenue, manageable, uncomfortable, but reducible through ordinary fiscal adjustment, a determined political coalition could address the trajectory through spending restraint or revenue increases. When interest payments are approaching 20% of revenue and heading toward 26%, And when the largest line items beyond interest are Social Security and Medicare, programs that serve constituencies with very high voter participation, the political mathematics of fiscal adjustment become increasingly constrained. The mechanism that was available in earlier phases of this cycle is less available now. This is what it means that a line has been crossed. Not that catastrophe is imminent, not that the system breaks tomorrow, but that the margin for error has narrowed, the cost of delay has risen, and the structural dynamics are now self-reinforcing in ways that require deliberate, consequential action to reverse. Action that the political system has not demonstrated the capacity to take. At some point, debt stops being stimulus. It becomes gravity. The United States borrowed its way through the 2008 financial crisis. It borrowed its way through the pandemic. Each of those borrowing episodes was productive. They stabilized the system. They prevented worse outcomes. But each episode also left the debt trajectory higher, and the interest rate at which that debt must be serviced is now structurally elevated. The next large shock, whatever form it takes, will arrive on a balance sheet that has significantly less capacity to absorb it through additional borrowing than the balance sheets of 2008 or 2020. That is the line that has been crossed. Not bankruptcy, not collapse, reduced capacity, narrowed options, a system that is increasingly borrowing to service existing debt rather than to create new value. Smart money sees this. It is reflected in the Treasury bill accumulation, in the gold flows, in the foreign divestment from long-duration U.S. debt, in the institutional positioning toward liquidity and mobility over commitment and duration. The public sees equity market highs and reads stability. The data shows something more complicated. Subscribe to Capital Briefing now if this video changed the way you read the current fiscal trajectory and what it means for the structure of risk in your own portfolio. Turn on notifications, leave one comment, one number. When you look at $2.8 billion per day in interest payments, growing to $5.9 billion per day by 2036, what does that change about how you think about the long-term purchasing power of the dollar, the sustainability of current equity valuations, and the relative value of assets that cannot be debased? Because the institutions that are asking that question today are not waiting for the answer to become obvious. They are positioning now.